The Federal Reserve kept rates steady at their recent meeting, but with a new incoming chair, what's next for policy in 2026? Also, interest rates are moving higher and agency mortgage-backed securities continue to outperform. So should investors still favor these areas? And should they be reconsidering credit quality? We're going to talk about all that and a whole lot more on today's UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Thank you so much for joining us today. Here with me in this conversation today is Leslie Falconio from the Chief Investment Office. Leslie, always good to have you join us on the show. Thanks for being here. I wanted to get right to it with you. We had a Fed meeting this past week, so the Federal Reserve did keep rates unchanged, as was widely expected. But there seems to be a lot of questions around where they're headed, because the path is a little unclear, knowing that we're getting a new Fed chair potentially coming in this year. So how do you see this playing out, and how do you think the new Fed chair could potentially alter the view that we're getting from the Fed in their recent statement?
Yeah, I mean, I think, those are great points. And, the one thing coming into this meeting that the market was anticipating was a much more balanced commentary from the chair, meaning that, when we look at what the fourth quarter and the concern that the market had for, say, the labor market and the focus that the FOMC was putting on sort of that full employment mandate, going into 2026, there's about, close to 80 cuts priced in. And this has changed a bit, right? We've seen a bit of recovery in the consumer, the unemployment rates come down, claims data has come down. And as, the chair stated in his commentary, 2026 is coming on a bit of strong footing, right? We have a lot of decent amount of revisions in the GDP numbers that wasn't expected. So the commentary in and of itself really wasn't as much of a surprise because the market was pricing in, prior to the meeting, 44 basis points of cuts in 2026. Again, that was from the 80 that was expected about 4 months ago. And you didn't have that much change after the meeting, right? What is difference now is whether or not they go in March or they go later in the year. And you'll have a varying degree in terms of what, strategists believe they go 1 to 4. That's really the range that we're seeing, to your point, Anthony, that there is a bit of divergence, the same way there's a divergence in the Fed committee about really what this path will look like. Now,
Right.
our expectation is, and we've had this for a while, that we're going to the Fed cuts, once. We have March on the table. We don't. It's very high. It's likely they could go twice. There's no question about that. There's not going to be a big economic difference between once or twice. But to go into a range where the neutral rate, as we would call it, goes to that 2.5 or 2.75, we do believe is a little bit extreme because our outlook is not for the economy to falter. We still have above trend growth. So when it comes to the new Fed chair, there's going to be a lot of rhetoric with this. And I think one of the biggest lessons learned, or should have been learned, is that just because the Fed cuts doesn't mean that the interest rates are going down, right? And one of the things that we have seen going back since September 2024, when the Feds, first started cutting, 175, ish basis points later, and Treasury yields are higher. So you can't just assume that if I have a dovish Fed chair, therefore interest rates are going to go lower. There's a committee to this, and obviously, more importantly, it's really going to depend on what the data is going to dictate. The labor market stabilizing, we have back-end inflation that has stayed relatively benign. But with all this fiscal stimulus, that can change very quickly.
Yeah, and just to kind of reiterate what we saw in the press release from the Federal Reserve, as you just said, they did say that they were going to remain data dependent and really keeping an eye on the economic cycle. So clearly there's, a lot of room to go here with what the Fed might be thinking for the year, but they're waiting to see what happens like we are. And you just kind of touch a little bit on 10-year yields, Leslie. Treasuries have really been in a pretty tight range for a while, between 4 and maybe 4.2% for several months, and it broke out from that upon the release of the statement. Now it's sitting at about 4.25%. So what do you think is behind the fact that we were so range bound for so long? And how do you see interest rates playing out now as we're going into this new year and this recent Fed statement?
Yeah, it's been really remarkable. Since the end of August, the majority of the time, the 10-year Treasury has been between, say, 4 and 4.25. This goes back several months. And, there's been a lot of headlines, a lot of rhetoric, a lot of data really during that time. And you really had this tight 10-year range. Listen, we're seeing a bit of a rise in the 10-year Treasury yield, and there's a few reasons for that. One I just mentioned is the markets, kind of saying, well, the economy is a bit stronger than what we first anticipated in the first quarter, so therefore, or even in 2026, so therefore, maybe the Fed won't cut those 3 or 4 times, maybe they'll go twice. That's the first part. So what happens is, as the Fed doesn't cut as much, the 10-year rates rise. And the second too is that what we're seeing sort of, globally, obviously we know there's this fiscal dominance and this a lot of um, fiscal issues, I would say, going on, whether it's Japan or Europe, that's, pushing those yields higher, and the US is highly correlated to that. And people have revised their growth outlook, right? So now we're getting, the back end, that 10-year yield slightly higher. Now it's our expectation, Anthony, and what we've written about is, last year when we hit our 4% target in 10-year treasury yield, we lightened up on some interest rate risk. We felt it was a prudent thing to do. We had interest rates come down from the 480 that we saw in January of 2025 all the way down to actually around to 390. So around that 4%, we started to lighten up. Now our expectation for 2026 is that the majority of the time, you're most likely going to be range bound between, say, 4 and 4.5 in yields in tenure. And that doesn't mean you're not going to see a 375 because we believe that you can. And that doesn't mean you might see a 475 if, in fact, we have, above consensus number, or if, we have Supreme Court decisions that there's a knee-jerk reaction. But it's really the sustainability will probably be between in that 4.5. So we're playing this. So we lightened up on interest rate risk at around 4%. And our view is that as the Fed cuts and the economy stays, it doesn't, go accelerating too high, but it stays above trend. You'll be range bound, and really that's how we're playing it for 2026.
Right. And you just mentioned you did take off some interest rate risk, as you said, at 4% on the 10-year yield. And we often talk about mortgage-backed securities, you and I. So when you look at agency MBS, they have been a favored sector of yours and CIOs. So with the administration kind of focused on housing affordability, which we've talked about a lot, you and me, Leslie, it was announced that Fannie Mae and Freddie Mac will begin to buy mortgages, which, that sort of adds an interesting part of the story to the agency MBS investment side. So given that, do you still like agency mortgage-backed securities given their outperformance?
Yeah, I mean, listen, I think, I've been on this with you, and you know this, as you just mentioned, and the outperformance that we saw in 25, spilling over into 26 was a long time coming, right? They had been cheap to their counterparts, say investment grade corporates, for quite some time. And we finally saw last year, a big pickup in performance. And part of that was due to the steepening of the yield curve, a large drop in volatility that we saw, better demand for the sector. That was really started the spread, sort of what we would call started tightening. And this recent event that happened, this month, while it was expected that the GSEs would buy, say, mortgages because they had the ability to do so, the announcement and the magnitude what's really caught the market off guard. So as a result, you had this really big compression in spread as hoping to bring down that 10-year treasury, or excuse me, 10-year mortgage or 30-year mortgage rate, which, as we know, the mortgage spread is only one component. You have to look at the 10-year treasury yield as well. And just to give you as a point of example, when we looked at, say, what we call the current coupon agency MBS, which is just what we call that par or $100, coupon, versus the IG index. Over the summer, you would be able to pick up 60 basis points in yield. And remember, the IG index is triple B. The agency MBS is, pretty much government guaranteed. That has compressed. So you went from picking up 60 basis points to now you're about 8 basis points because of this tightening. So we still like the sector. We think it's really important to balance and diversify between, say, corporate credit and, say, securitized product, to get a balance in terms of risk, to get a balance in terms of how things may play out in terms of corporate supply or AI during this year. But the sector has done well.
Excellent. Thank you, Leslie. I want to ask you about investment grade corporate bonds because currently CIO has a neutral view on IG corporates. And when we started the year, there was a concern that increased supply in IG corporates from AI and rising M&A would potentially end up widening credit spreads, yet it looks like they've recently made a new 25-year tight. So the question then, when you're looking at credit quality, is should investors be concerned about IG corporates, and why not just go into lower credit quality if that even is a concern?
Yeah, I mean that's such a great point, and because if you remember especially during the last 2 months of the year, with all the supply that was coming from AI and all the issue regarding debt service and all this issue in the back end, everyone was sort of having this really big concern over investment grade corporates, and I think because of that, you ended up actually seeing some risk taking, some people taking risk off the table, if you will, given the fact they did well in 2025. Well, lo and behold, we have supply that's come in year to date in IG corporates at almost like 180 billion, which is some of the, from a January, it's one of the biggest January months we've seen since like 2015. It's about 30% higher than what we saw from the previous year. And yet we have IG corporate spreads that now, according to the BAML index, at 73 basis points, which is over a 25-year tight. So I think that part of this is the fact that people took a little risk off the table when you had all that hype that was going on about how much supply would be in the marketplace, due to AI, due to increased M&A. That now we're in the beginning of the year, people are looking at a growth outlook that's a little bit stronger. They've been oversubscribed in some of these deals. Now, when we think about the relative value of investment grade corporates, we do not believe by any stretch there's going to be a fundamental crack in credit, particularly higher quality. Is there a tremendous amount of value in terms of spread compression? No, there's not, but there's really a lot of value in terms of compounding income. And that's where we're looking at that. You're able to have 4.95% compound for an investment grade corporate. That's still, in our opinion, very attractive. So we're not expecting a huge outperformance from the sector. And, given the fact we do have treasury yields coming down a little bit, you might have a little bit of price appreciation, but it's really going to be from that compounding income that you're going to be the tailwind to total return. We do expect, however, particularly out of the gate, as you mentioned, lower credit quality has done incredibly well. MBS has done well. IG has done well. Really, risk assets the first 3 weeks of the year have done very well. We wouldn't necessarily get too comfortable with that. And what I mean by that is you're going to have these periods of widening, not a crack, not a debacle, just simply widening in spreads. But we look at that more opportunistically versus concerned about risk taking this year.
Great, and thank you again, Leslie. Great to have you join us. And thank you all for being with us today. For more information, please visit our Insights website at ubs.com/views. Lots of CIO content for you there. Plus, you can follow UBS and UBS Studios on social media. We are on LinkedIn, Instagram, and Facebook. And on Instagram, you can follow our dedicated channel at UBS Trending. Lots of great stuff there for you. And as always, if you have any questions or want to continue this conversation, make sure you're connecting with your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day, and remember to keep your eyes on what's trending. We'll see you soon, everybody.